Hello, everybody. Welcome to today's webinar. Very glad to be joined today by Defaqto. Patrick is going to be giving us a talk on ESG investments. Patrick Norwood is actually the investment consultant on the funds and DFM side at Defaqto, and he's going to give an overview on ESG investing. We are then going to be followed by the TAM team, which is Stephanie Soteriou and James Penny, who are going to talk about greenwashing and riskwashing and how important they are in the market at the moment. I'm just going to hand over straight away to Patrick, who, as I said, will be giving an overview on ESG investing for us.
Thank you, Joe. Today I'm going to cover two parts in this presentation. I'll first of all go through some of the latest facts and figures around ESG, and then I'll cover the different levels of ESG investing. So, starting off with the latest ESG trends, this chart here shows the size of the European Sustainable Fund universe over the last few or so years. We can see that it's steadily grown over this time and stood at just over $1.3 trillion at the end of last year. This chart here shows actual flows into the European Sustainable Fund universe over the same time period, and again in billions of US dollars. Q4 of last year saw record-breaking inflows of just over 120 billion, twice the inflows in the previous two quarters. If we look back a bit further, we can see that flows really started to pick up at the beginning of 2019. There was an interruption due to COVID in Q1 2020, and then the acceleration towards the end of last year, which I mentioned. This chart here is the same one as on the previous page, but this time broken down by asset class, with equities in yellow, fixed income in orange, and multi-asset in blue. We can see that over the last few quarters, equities have been the asset class of choice for European sustainable investors, with record-breaking inflows of 82 billion in the last quarter of 2020. Fixed income is the next most popular, but well behind at just over 20 billion in the final quarter of last year. European Sustainable Fund launches, which we can see in this chart here, have been on a rising trend over this time. And the orange line on the right-hand scale shows the number of European sustainable funds at around 3,200 at the end of last year. The left-hand scale and the bars talk about fund launches over the last 5 years. The lighter blue part of the bar is brand new fund launches, while the darker blue part of the bar is those funds non-ESG, which have been reconfigured into ESG funds. We can see that over this time, the proportion of funds which have been repurposed or rebranded has gradually increased. This is not really surprising. It's much easier for a fund manager to leverage off existing assets than to create a fund from scratch and have to raise seed money and go through other bits of administration. Investors, though, should be aware of greenwashing in this area, and the TAM presentation will talk about greenwashing shortly. This chart here looks at just the UK market as opposed to Europe, and looks at inflows over the last couple of years. The inflows of 10 billion in 2020 was more than 3 times the inflows seen in 2019. Despite the strong growth, however, ESG still represents just over 3% of the UK market, hence still scope for considerable growth going forward. Studies, meanwhile, continue to show outperformance of ESG investing, or at least no performance penalty. On the left-hand side, we can see that 3/4 of Morningstar's ESG indices outperformed their broad market equivalents in 2020. If we increase the measurement period to 5 years, this number increases to almost 90%. And if we look at just down markets, including the COVID down market of last year, the number rises further to just over 90% of ESG indices outperforming their non-ESG equivalents. The TAM presentation shortly will talk about performance in a bit more detail, in particular growth versus value investing. Moving on now to part 2 of this presentation, the different levels of ESG investing. Many of you will have seen this illustrated as a spectrum, often different shades of green, but I've decided to go for the pyramid here. Starting off the base of the pyramid, we have ESG integration, where ESG risks are considered as part of traditional analysis. We then have exclusions, where certain companies deriving a percentage of their revenues from so-called controversial areas such as alcohol, gambling, tobacco, and many others are excluded from the universe. We then have sustainability, which is less about screening out the bad and more about trying to include the good. And then finally, we have impact investing, investment with the intention of achieving a specific positive and measurable environmental or social impact. And I put in italics the words that we at Defaqto think are the most important in that definition. It's worth noting that funds can and often will have more than one of these different levels in them. They don't have to hold just one of the levels in their investments. Starting off with the base of the ESG pyramid, ESG integration. I've given the definition in italics at the top, but really we've all seen headlines over the last few years how environmental disasters and bad governance have caused share price falls in even the best known of companies and damaged their reputation over the long term. And ESG integration is just doing the analysis to try and avoid these types of risks happening. Moving on to the next level of the pyramid, exclusions or negative screening. As I mentioned, this is about avoiding exposure to certain so-called bad or controversial areas. This is the oldest form of sustainable investing and probably the type that people are most familiar with. Latest data shows that this is still the most popular type of sustainable investing, although other types such as impact and sustainable are growing at much faster rates. This chart here shows a screenshot from Defaqto's Engage. As of a few weeks ago, users are now able to set limits on certain controversial areas such as nuclear power, fossil fuel, animal testing, and several others in order to try and screen out funds that their clients may not be happy with. Next level of the pyramid is sustainability focus. This is less about screening out the bad and more about trying to include the good. But as well as that, it's trying to invest in companies expected to do well from E, S or G trends over the next few years and even decades. For example, investing in companies that will benefit from the shift to renewable energy away from fossil fuels. Fund managers will often use ESG ratings from third-party providers such as MSCI and Sustainalytics in order to try and find best-in-class ESG investments. You should, though, be aware that there is still a lot of subjectivity in this area. So many different ESG data points out there, different criteria which can be used, different weights that can be put on these criteria, and other differences in methodology. So often you'll get different providers coming up with different ESG ratings for the same company. I use Shell as an example to illustrate this. On the left-hand side, I list some of the good things about Shell, and on the right-hand side, some of the less good things about the company. Bringing all the good things together, Shell received a good A rating for ESG from MSCI. But bringing the bad things on the right together, Shell receives a high-risk ESG rating from Sustainalytics. So, different ESG ratings from different ESG providers for the same company. This also applies to funds and is one reason why we at Defaqto haven't produced ESG ratings for funds. Instead, we produce an ESG review document, which is 6 pages long and covers things like the fund's ESG policy and alignment to it, any involvement in controversial areas and reasons for that, what the fund is doing in terms of the different levels of the ESG pyramid, and many other things. These documents are produced after at least one detailed meeting with the fund manager, and they sit on Defaqto's Engage. Moving on now to impact investing, the top of the ESG pyramid. This is where investment is made with the intention of generating a positive and measurable social or environmental impact, with emphasis on the positive and measurable. So the fund or fund manager must demonstrate that the money is being used for positive social and environmental impact. So an annual report will be produced each year with stock by stock, line by line, showing things like tons of CO2 saved, volumes of water, litres of water saved, etc., for all the various investments. At the moment, there's very few standalone impact funds. Often the investment will have mainly sustainable with a few impact investments thrown in. We expect to see, though, more pure impact funds going forward, especially with the continuing improvement of ESG disclosures from companies. As a result of more impact funds going forward, we expect to see more fixed income in ESG investing, in particular green and social bonds, but also social housing. So to finish off, where do we see ESG investing going? What are the likely future trends? First of all, the strong growth in ESG investments, which we saw near the beginning of the presentation. We see no sign of this slowing. If anything, product innovation and solutions won't be able to keep up with the expected growth in client demands. We also expect to see more impact, more sustainable investments going forward rather than exclusionary investments. And then related to that, we expect to see more fixed income in ESG investing and also more multi-asset for that matter, as opposed to equity only in ESG investments. Fund launches, there'll be more non-ESG funds being reconfigured into ESG funds rather than brand new fund launches. And finally, we expect to see ESG integration, ESG embedded in all in funds in some shape or form. It will just become something everybody expects to see in a fund or investment. That's all I had to say about ESG investing, and I'll now hand you back to Joe. Thank you.
Thank you, Patrick. Very insightful presentation, overview on ESG investing. Patrick will be around for questions at the end, everybody. So if you'd like to send over any questions, please do. Patrick and Stephanie from the next presentation will both be around to help take those questions. What I will do is just hand over to Stephanie for the next portion from TAM Asset Management, which is titled Greenwashing and Riskwashing.
Thank you, Patrick, for your opening presentation. Today we're going to be speaking about greenwashing and riskwashing. Greenwashing, a term most of you have probably heard of, but riskwashing perhaps not, and we hope by the end of this presentation you'll understand what we mean by that. As a brief introduction on who will be speaking today, my colleague James Penny, CIO, and Stephanie Sotirio, Investment Manager of our ESG portfolios. I'm sure most of you listening today will be aware of how much ESG investing has grown in the last few years, particularly last year, 2020, was the year that ESG really did take off. 2020 was the ultimate stress test for ESG investments, for those funds that claim to offer that greater downside protection during turbulent markets due to the nature of the investments that they hold. What the COVID-induced market sell-off really did highlight to us was the importance of owning quality companies, which is at the center of most ESG-focused strategies. We saw an increased focus on the S and the G, the social and the governance aspect of ESG, alongside the environmental, which has historically been the main focus. Companies with strong balance sheets, sound corporate governance practices and strong management teams proved to be the most resilient during the market turmoil in Q1, and ultimately they were able to withstand one of the toughest years for financial markets. But perhaps most significantly for us, what 2020 did was it really did bust that myth that you have to sacrifice financial returns in order to invest sustainably. So this chart really does highlight that for us. We've shown a mainstream equity, global equity index alongside 3 versions of ESG indexes. So along the bottom, that black line is the MSCI World Index. This is the mainstream index over the course of last year. Just above that, we've got the MSCI World ESG Focus Index, which is, it's an index that focuses on ESG integration. So this is a slightly lighter green index. But the standout really is that dark green line along the top, which is the MSCI Global Environment Index, which is an impact index. So that's along the darker green scale. We at TAM blend a range of ESG strategies, so we'll be using all of the above, but it just really does highlight that outperformance that we saw last year. The growth in ESG can also be seen in the following chart. So what we saw last year, ESG was already on track to transforming the investment landscape even before the coronavirus outbreak, but last year we saw a significant number of new ESG funds coming to the market in order to meet that growing demand that there was. In fact, the number of investment funds focused on ESG more than doubled in 2020 compared to 2019. So for us as investment managers, as fund selectors, this would normally be great. It widens the universe of funds to select from for us. But there is a danger with the new ESG funds coming to the market, and we think that this chart really does highlight that. So what we can see here is that although the proportion of newly launched funds has been increasing steadily, that proportion of repurposed and rebranded funds has increased significantly in 2020. So this leads us to question just how ESG those funds may actually be. We question the possibility that some fund managers may have seen this growing trend towards ESG and wanted to get a piece of the action. You know, how easy it's much easier to stick an ESG label on an existing fund with the track record. Of course, that I'm being quite facetious with that. I think it is an overly simplistic view, and I think there's a lot of fund managers definitely don't do this. But I think with the sheer speed and volume of fund launches last year, it has led us to be quite skeptical of this. So what we've just described there could be an indication of greenwashing. So greenwashing is essentially an attempt to capitalize on the growing demand for environmentally sound products. So it's companies that could be providing misleading information about the green credentials of their products and services. This can be companies, and we will go on to explain some examples of those, but it can also be at the fund level, which is what we're mainly concerned about. So we're looking more closely at how fund managers label their funds. They need to be showing that robust ESG process alongside that label for us. So some examples of some companies which have been involved in some greenwashing scandals in the past you may be aware of. So we've got Chevron here, and the People Do campaign back in the 1980s, where they were broadcasting their environmental dedication through this really large campaign, but at the same time they were engaging in many environmentally unsustainable practices. The picture of the towels actually represents how the term greenwashing was in fact coined. So this was an environmentalist who was at a beach resort, and he saw promotions of reusing towels in order to save the oceans and the coral reefs. But he found that quite ironic given the volume of tourism and the expansion that was happening in the area at the time. So he concluded that the act was actually just a cost-saving measure. More recently, we have Volkswagen, so the clean diesel scandal, where Volkswagen was cheating on their emissions tests. And then finally, many of you may have seen the recent documentary on Netflix, Seaspiracy, which called out companies who were using the dolphin-friendly label on their tins of tuna, even though they really had no way of assuring that no dolphins were being harmed during their fishing. So how do we avoid greenwashing? I think the main point for us is conducting a thorough due diligence of all the funds that we select within our ESG models. This starts with an initial one-to-one meeting with fund managers to really drill down into their investment process, particularly their ESG screening process. But we don't leave it there. Once an initial fund is added to the models, we review them regularly. This is usually a meeting every 6 months to make sure that nothing has changed in terms of the investment process, in terms of the performance, and that we're happy with the performance and the recent activity within the fund. And this really helps us to identify and act quickly if we see any problems. An example of this actually was last year. We became aware of the scandal involving fashion retailer Boohoo around its labour practices. And we immediately arranged a meeting with the fund manager of the fund that was holding shares in Boohoo. And after we reviewed this, we weren't comfortable really with the explanation that was given to us, and we immediately sold out this fund. So this really highlights as well the danger of that reliance on third-party ESG providers as well. So at the time, it would have appeared that Boohoo was scoring highly by the data providers, but in fact it wasn't. So this really shows for us the importance of not relying on those third-party data providers and really doing our own thorough and in-depth analysis as well. And then finally, no compromise. So there may be funds with a slight greenish tinge to them, but for us that's not enough to be included in our ESG models. We really do need ESG to be at the core of the fund's investment process. So ESG so far this year, it's fair to say that ESG has had a challenging start to the year, given that it was coming off such a high from 2020. We have seen one of the most powerful market rotations in recent history this year, which began towards the end of last year following on from the vaccination rollout. There's been a huge shift away from highly valued growth companies, largely technology stocks, those of which performed really well during the COVID pandemic. But now we've seen a move towards those more economically sensitive shares, such as banks, airlines, and energy, the ones that are most likely to benefit from the economic growth going forward. This rotation really did pick up steam this year as we saw rising expectations for economic growth and inflation fears, which really did weigh on the stock market, and it had a particularly sharp effect on those COVID winners from last year, which were already trading at elevated levels. So what does all this mean for ESG investing? By its nature, ESG funds have high quality companies in them, those whose shares are highly valued compared to their earnings, given the strong growth prospects for these companies. This, coupled with the exclusions of the so-called sin stocks, leads to a bias towards sectors such as technology and healthcare and away from those more cyclical stocks, such as energy and financials. So we believe that this is the main reason for the underperformance that we've seen this year. What we think is really important is to focus on the long term and look past any short-term noise that we may see. As this chart shows, this is a 3-year performance chart of our TAM ESG models. This is through from defensive all the way through to adventurous, and you can see over the long term some really impressive and pleasing results from our ESG models. We need to think more about the actual sustainability themes of many of these companies that we're investing into, such as decarbonisation, water management, digitalisation, enabling healthy lifestyles, and so on. These will be our future growth drivers. These are also the areas that businesses and governments, as well as regulators now, are paying so much more attention to, and is likely to only continue going forward. Again, this is a 5-year chart, and you can see, for example, an ESG balanced portfolio has delivered almost 30% return over 5 years, which, for us, we're really pleased with. What I also want to draw your attention to with this chart is how, for each of these portfolios, as they move up in returns, they also move up in risk. So for us, this really highlights how we carefully manage that risk within our portfolios. So on that note, I want to pass over to James, who will be explaining the term we have coined riskwashing and its implications.
Good morning, ladies and gentlemen. Thank you very much for dialing on. What I want to do is talk about an addendum to the greenwashing topic today, which is riskwashing. Riskwashing is something that's not exclusive to ESG investing. I think it's prevalent to the whole market. Essentially, riskwashing is looking at the risk within one's portfolio and how much it's taking for the returns that you're getting, and importantly, versus the name on the door of the profile that you're buying. So what I've done here is I put forward a few points just to kind of illustrate that. But essentially, as an example, which I've got in a slide coming up, is one investor can buy what they believe is a balanced portfolio, and they believe for their clients they are achieving a balanced investment for that client. But actually, when they look under the hood into the fund or the portfolio, they can see that they're taking varied levels of equity exposure, and equity exposure is akin to risk. So you can find in a balanced mandate that some clients, some managers will be taking 30% equity exposure. Some in extreme will be taking 75% equity exposure. Yet the name on the door for that product can be balanced. It is, to an extent, misleading because it is not showing you the true nature of the investments that lie under that name. And that's what we coin the term risk washing. They're calling it balanced, and they're washing the risk that they may be taking. They may be over-risking a client portfolio, yet via calling it balanced, they're making out that it's a more balanced mandate. That is something that we disagree with. So I've put here, do investors know what is in a name? Do you know what you're taking when you buy a balanced portfolio? Do you know what you're taking when you buy an adventurous portfolio or a defensive portfolio? We believe it's critical in this day and age to make sure it's not only looking at the headline title of the portfolio, but what is in it. What does balanced, going on to the second point, what does balanced mean to you and your clients? What does your client want? Do they want a balanced mandate, or do they want a risk balanced mandate? We believe that they're very different things. If your client wants a balanced approach to risk, we don't believe that taking a portfolio with 75% equity exposure is appropriate. Yet it is still called balanced. It's something that we want to watch out for. Underneath that, I've put the relationship between returns and risk needs to be better understood. Over the last 5 years, I've seen plenty of portfolios that call themselves balanced, delivering market-beating returns. But it's obvious why they've generated those market-beating returns when you look at the level of risk that they're taking. It's obvious that the ones that are taking 75% risk have massively outperformed. We do get some clients coming back to us and saying, well, why should I own your portfolio that's a balanced portfolio when I can own a portfolio over here that's returned 20, 30% more than you have? And the answer is simple. Well, go and look at how much risk they're taking. And it's very obvious when you do that, you can see how they're achieving that. But again, you must understand that the risk that's being taken in that portfolio is far greater, which means when volatility turns up, that portfolio will underperform much more and much sharper than a more balanced mandate. When it comes to ESG investing, I think this could get worse. I think for a number of reasons it could get worse in the ESG market. The ESG market is a tighter investment set. Yes, it's still becoming more broad. It's becoming more mainstream in terms of ESG investing, but there are less products in the market. Investment managers could be tempted to increase their exposure to various different funds because of lack of choice, and therefore increase a client's risk exposure, yet still call it a balanced ESG mandate. Yet we believe that it could be, you could be moving further up the risk scale. So what we're doing here is we're talking about risk washing. Obviously, TAM takes this very seriously, and we believe we have an answer to risk washing, but this is something that we think is prevalent in the market. I'm going to move on now to a very quick diagram, an illustration, if you will, of what I'm talking about. So all of these portfolios are balanced. They're all called balanced. One is taking 40% equity. One is taking 50% equity, and the other is taking 85% equity. And these are products in the market. We've not named them, obviously, apart from us in the middle. So 40% equity, we would say, is a slightly more defensive approach. 50% equity, where TAM is what we believe is balanced. 50-50, it makes sense to us. 85% equity, we have seen managers calling this a balanced approach to investments. 85% for us is fundamentally an adventurous, high-risk portfolio. Yet, any manager or investor looking at these three, and looking at the balanced mandate, looking at the returns, might pick the one on the very right because it's returned the most, yet it's still called balanced. That, we believe, is inherently risky because you're not looking at the underlying portfolio. So, very quickly, our assessment of risk. TAM sees risk in an absolute measure. We see it versus our benchmark. How much risk is our benchmark taking? We want to take a lower level of risk than that. We are not happy with taking a higher level of risk than our benchmark because it is what we stick to. It's one of the core pillars of how we invest. The benchmarks that TAM look at are whole of market benchmarks. FTSE All World, FTSE All Share, government debt. Very, very mainstream benign indexes. And we seek to always generate returns lower than that. What is important to us when it comes to risk? It's important that we're delivering the risk level that our clients signed on for. Our clients did not sign on for a balanced mandate. They signed on for a level of risk. That level of risk is a balanced level. So it's important to us that when we're expressing balanced, cautious, growth, adventurous, those are just names. Underneath that is the level of volatility that we're exposing them to. And that for us is critical. So I've put here what is important for you as advisors to watch out for, not only in ESG investing, but in mainstream, is to look under the hood. I urge you to look under the hood of the models and the portfolios that are running and see how the returns are being generated. Make sure that you're happy with the level of risk that's being taken to achieve those long-term returns. Because if the market turns against you and you have a balanced mandate that is over-risking itself, you need to be aware of that when you're investing for your clients. Now, TAM obviously makes sure that we have extremely detailed, laid out approaches to risk. Remember, don't be afraid to ask questions. Whether that's with TAM, whether that's with another manager, make sure you're looking at the investment composition and you're asking the questions about how they achieve their exposure. It's very important. Performance is something here that we put down in our mainstream portfolios. It's akin to our ESG portfolios. The returns we're very happy with, especially when you consider that they are we take a balanced approach to risk. So every single one of these staggers up, as you can see. As we take more risk, the returns increase. You don't start to get outliers jumping ahead of other portfolios because we are playing around with the risk more in one model than another. This, I just want to highlight from these investments that we are taking a measured approach to risk, and you can see that sequentially moving up as we go through the timelines. So to conclude, whilst an expanding ESG fund universe is positive, there is a risk of greenwashing, absolutely, and we need to watch out for it. As TAM, as investment managers, we are doing that on behalf of our clients. Calls for in-depth analysis and significant due diligence, absolutely, that's only going to increase. ESG investors must look past short-term noise and focus on long-term growth opportunity. At the end of the day, we are long-term investment managers seeking to invest a portfolio for you and your clients for the long term, not the short term. ESG is a fantastic opportunity long term. Finally, risk washing, mainly in comparison of apples and pears. Don't be afraid to ask questions. You need to understand on behalf of your clients how the exposure and returns are being generated. Make sure you ask questions. They're there to answer them. Thank you very much. What we're going to do now is hand back over to Joe for some questions.
Fantastic. Thank you, James. Thank you, Stephanie. Really, really appreciate that. James has had to shoot off at the end of that presentation, but we do have Stephanie for questions along with Patrick from earlier. One thing before we do get into questions, I just want to touch upon, as we were just talking about risk washing, obviously TAM maintains a level of risk across all of our portfolios, but we also outsource that to Defaqto. So on mainstream portfolios, we have 7, which are risk rated by Defaqto, a clean sweep from 2 up to 7 on the risk ratings. And on our ESG portfolios as well, we have a 3 to 7 clear sweep across the 5 portfolios. With that being said, we do have some questions that have come over. Pardon me. Please do feel free to keep sending them over. If they don't get answered today, we will email you individually with answers. The first one is a very TAM specific question. So Stephanie, I'll ask this one first off to you. The question is, how diversified are TAM's ESG portfolios in regards to the different styles of investing, i.e. SRI, ESG, impact, positive and negative screening?
Yeah, so we invest across all of those styles, and we've always marketed our portfolios as being quite, not the deepest of green, they're quite sustainability focused, and we really try and appeal to the widest range of ESG conscious investors. So we do blend a range of positive impact, the more negatively screened type of funds, positive screened, we use a range of all of them, and we think that that's the best way to generate the best returns as well as to deliver the best results from an ESG perspective.
Sure. Thank you very much. The next couple of questions I think could be positioned at either or both of you guys, actually. So if you'd like to answer that, that'd be great. When trying to select an appropriate ESG solution, how can I easily differentiate between one which has been greenwashed and a solution which was constructed specifically for ESG?
Okay. Shall I go first? I'll go first.
Yeah, ladies first. Yeah.
So I think there's a lot of telltale signs that I tend to look for when I'm looking at a fund, and there's questions that I ask myself. Some of them being, is the ESG process explained clearly and simply? A lot of the time, there's a lot of marketing jargon that's used, which is a bit of a warning sign for me. You know, like ESG is in our DNA and things like that. I just think sometimes alarm bells ring. I think also, is the ESG analysis conducted by the fund managers and the analysts themselves, or which is usually preferable for me, as opposed to being sort of a siloed ESG specialist team somewhere else. Other things I think to look out for, often at the top level, it's quite nice to see that a fund management company is a UN PRI signatory, so Principles for Responsible Investing signatory. That's always good to see that the company is taking it seriously from the top level. Engagement is great to look out for if the fund manager is engaging with companies and there's impact reports being produced, things like that. So for me, these are the kind of things that I look out for.
Yes, I mean, lots of those things are just said as well. Yes, as somebody said in the TAM presentation, it's getting under the bonnet, getting under the hood. Is ESG reflected throughout the investment process, or at least in parts of it? And also, does the end portfolio reflect all that? You know, look at individual holdings, question the manager about any ones that don't look right. So as they're getting under the hood and just looking at the end portfolio.
Sure. Patrick, this seems like a perfect question for you. How can I try and eliminate risk washing from solutions I have for my clients without adding more workload?
Yes, well, I mean, as you said a couple of minutes ago, Defaqto, we do risk rating. We risk rate the TAM portfolios and many others. We look at the portfolio's past volatility. We look at its current asset allocation, project that forward, analyze all of those volatilities on our 1 to 10 risk scale. And also we discuss those with a fund manager. We recognize it's an art as well as a science when we come up with a rating. We don't just, when we've made the ratings, we don't just stick them on engage and forget about them. Every 3 months, we'll come back, look at the rating again, get the latest past volatilities, get the latest asset allocations for the manager, redo the analysis, and if there ever are any breaches, discuss them with the manager and possibly alter the risk rating. We're aware of the fact that one person's defensive might be another person's cautious. So, we do all that for the providers.
Brilliant. Thank you, Patrick. Again, another one for both of you, but we'll go to Stephanie first. Patrick, you may be able to answer this from the perspective of the ESG forms that you discussed earlier. But Stephanie, if you could go first on this one. It's the age-old question. One man's bad nuclear power is another man's good nuclear power. So one man's nuclear disaster is another man's clean energy. With interpretations like this, can we effectively avoid greenwashing in funds and portfolios?
Yeah, I think that's really the key reason why we have greenwashing at the moment, because there can be quite blurred lines between what actually is considered ESG or sustainable and what isn't. I think there is a lot of progress being made on that. I think the UN Sustainable Development Goals were one of that, and that came in quite a while ago, that fund managers now use as a way to map and to really evidence the impact they're producing in their funds. I think we've also got the EU, the taxonomy system that's coming into place as well. So that's a really great way of classifying and defining what is an ESG sustainable activity. So I think in terms of the regulations and sort of governments and all these that are taking this more seriously now, I think there's definitely going to be a more clear definition coming through. So yeah, I think it's just one to wait for and hope it improves really.
Brilliant. Thank you, Stephanie. And Patrick, from Defaqto's perspective with the ESG reports that you mentioned in your presentation.
Yes, I think it comes back to the fact, as we said in the presentation, there's so much subjectivity in this area. For example, some fund managers will totally avoid certain companies that do have a lot of fossil fuels. They'll completely avoid them. And then other companies will invest in them to try and improve them, to try and work with them, to try and engage, to try and improve them. So some hold them, some avoid them. Yes, there is this subjectivity around this, with different data points that can be used and so on, different ways of interpreting them.
Brilliant. Thank you very much. I think we've got time for one more question. We said that we try and keep this to 45 minutes. So again, if both have an opinion on this, we'll start with you, Patrick, if that's okay. With risk washing having been a thing for a number of years, purporting to be balanced fund with high levels of equity, as James did explain in the presentation, do you see a way of this being standardised by stricter regulation, so outside of what Defaqto are doing, as in from the FCA improved guidelines, etc.?
Yeah, possibly. It's difficult because obviously they have limits, like you've got IA limits anyway, investment association limits, if you invest in certain sectors. But then there are wide bands around there, like the 40 to 85, you'd have 45% in equities, 80. So on the other hand, you don't want to limit the funds too much. You don't want to have they've got no freedom, no freedom at all to react. They're aiming for a certain risk target, and then if markets, massively rise, massively fall, they've got to be able to adjust to keep the volatility within certain bands. So there's this trade-off between being too strict and giving them some leeway.
Sure, there's definitely that middle ground between too much regulation and not enough.
And then they can't do anything, so there's too much. Yeah.
Definitely. And Stephanie, if you have anything to add on that point?
Yeah, I think, like Patrick said, the band is so wide. I do think that there is possibly scope to segregate that out a little bit, maybe 40 to 50%, 50 to 60, and maybe to separate it out a bit rather than having such a wide band. I think it's possible. I think the regulator is just more and more involved now in the day-to-day and what we're doing as an industry. So I think it's definitely possible. But obviously, like Patrick said, not too much, not to be too strict and to be to limit the too much. But yeah,
sure, brilliant. Thank you guys for that. Really, really appreciate you taking the time today to do these presentations and to address these questions at the end. Obviously there's been two key points that we've touched upon here with greenwashing and risk washing. There's a lot of work involved from an advisor perspective on these points. Obviously, TAM is here to help with DFM perspective, to help sort of see through the weeds and all this sort of stuff. And obviously Defaqto as well, through their various different measures, whether it's the ESG reports, whether it's the risk ratings. So from both our perspectives, I hope Patrick won't mind me saying, please do feel free to get in touch with either of us if you have any issues on either of these points. Slides will be made available after this presentation. We'll make sure to email those over to you guys. Please do leave some feedback for us on these, because as mentioned on previous presentations, it really does help us shape and moving forward. But apart from that, again, thank you, Stephanie, thank you, Patrick, and thank you, James. And enjoy the rest of your week, guys. Really appreciate you taking the time.